A mechanical trading setup that makes money. What I'm about to share with you in this video is a mechanical trading setup that makes money in the long run. At the end of this video, you know what I'm looking for in the markets to make consistent money from trading. I will be talking about three things. Topic number one, the concepts that I use inside my mechanical trading strategy, the proven statistics behind my strategy, and the actual setup that I took that made me around 2,000 euros in a few days. By the way, are you enjoying my videos? Subscribe to the channel so you don't miss anything. Alright, so the first thing I want to discuss with you is the basis of the entire strategy. These are the concepts that are inside the strategy. And it's really important to understand the concepts that you're using, because you can give someone a mechanical strategy, but if you don't understand how and why it works, then it's really hard to stick to it, especially when you're having like a drawdown. When you have a bad period, you can really get doubts, and then if you don't understand why something works, that can really harm you. So let's dive into the concepts that I use inside my mechanical trading strategy. One of the concepts, and the main concept, is the concept of liquidity, and that's basically key in my trading. So what do I mean by liquidity? I've highlighted this key swing high. Let me put the line correctly. A key swing high on the daily time frame. Now everyone can see this key swing high, everyone. So when we go into that area, you get people shorting it as resistance, and especially on the lower time frames, you can see that the market drives into it and then slows down a bit, and a lot of people are like, oh, the resistance is holding, I'm going to short. The stops are all going above the key high. That's just what happens a lot. Also, people will be looking to buy as soon as the area breaks. So you get these breakout traders, trend followers, that will be executing longs above here. So essentially you get two different parties both executing longs as soon as that level breaks. What I'm always interested in is what happens when that happens. So you can see that we break the level, immediately we reject, go up a bit, and then we fall down. Now this is a clear example of absorption of liquidity by a bigger player, and that's like the core of my mechanical trading strategy. That's where I build my edge upon. So let's give you another example of this. Take a look here. We got two equal daily highs. This is a very obvious area. Price runs into it, probes above, buying will be triggered. People will be buying the breakout, stops will be triggered. Rejection, then we retest the level again, rejection, and then we fall down. I use these things as a bias, and I use that concept inside my mechanical trading strategy. Now, how is this mechanical? You might be wondering. The way I trade is simple. I wait for a range, I wait for a false breakout, so liquidity being taken out, and then I wait for a real breakout, and I play for the next leg up. So the concept of liquidity is inside my mechanical trading strategy. And this part right here, this is what I made fully mechanical. So I've built very concrete rules around this. And from there on, I started testing it over years and years of data. And then when I got the data, it proved to me like, okay, this has worked in the past. This provides me with an edge. And that's how I build it. But it all starts with concepts, guys. And if you're like struggling right now, it's probably because you've learned concepts, but you never like narrowed it down into a strategy with clear rules. That's what a lot of people don't do. They like, oh, I learn a concept, and then they're like, okay, let's get cracking. But they never like put it together in a strategy that they can execute over time and that has worked in the past. And that's why it's so important to have proven statistics about it. So how did I go from concept to mechanical strategy? I basically started thinking, okay, where is liquidity? How can I define it as clearly as possible? What I mean by that is, let's say that you are a breakout trader. How are you going to define a breakout? I define a breakout by a break above a previous day key high. That would, for me, for example, be a breakout. Now, how will you define a key high? You have to think about these things because you can't just trade empty concepts. You really have to build a trading strategy around it. So this is the concept I use. The liquidity being below here. I want to see it being absorbed. Then I want to see a real breakout and a close above and different behavior here than here. So we break the range to the upside as well, but there's completely different behavior here than from here. And again, it sounds very vague, but I made this fully mechanical. Of course, I can't give you everything because my mechanical trading strategy is for me and for the people I mentor. It took me a long time to build it, and I'm not just going to give it away for free. And also you need guidance with it, so that's why. But these are the concepts I use in my trading strategy. Very simple concepts built into a mechanical trading strategy and executing it. But how did I get my statistics? Let's take a look at that. Right, so on the screen you can see my statistics about this strategy in euro-dollar. Now, I made my rules, they're not here, but these are the statistics. And how did I test this? What did I test to begin with? I always start really, really simple, and that's a tip I want to give you right now. If you're developing a strategy, start simple, guys. What I tested was simple. I made rules for this pattern. Clear rules, non-subjective, fully mechanical. And what I tested is, I want to play for this move. How often does this target hit? It's very specific before taking out this low. That's what I tested. Really, really simple. Again, I had rules for the target, but really simple stuff. Then I tested, okay, what if the target is twice as big? What if the target is 3 times as big? How often does that happen? Really basic stuff. That's what you see here, 1R, 2R, 3R. How often does it hit? 60% of the time. How often does 2R hit? 38% of the time. How often does 3R hit? 26% of the time. How often does 0.5R hit? 73% of the time. That's where I started with. And then basically after having the basics down and seeing a small edge there, that's when I started improving. And that's when all this came and all these tabs came. So that's where you want to start, guys. Start really basic, build proven statistics about your approach. Proven statistics. I've tested this back to, take a look at that, 2008, 2009 is a full year. We're now at 2022. That's a lot of years. Sample size is decent enough, especially over all these years. And it has been tested during COVID, during crises, now with the war, tested during different periods. And if I go down, you can see it performs very well during all these periods. This is what you want. You want to go from the concepts to rules, testing it, getting proven statistics, and then executing from there. So let's take a look at a mechanical trading setup I took that made me around 2,000 euros within a couple of days. So this is the setup I took. I took a short in the USD GPY, completely mechanical. I simply put in my level, I put my stop, I put my target, and that's it. All based on statistics. Again, the sheet I just showed you was in the euro dollar. I have the same thing in every pair I trade. So I also have a sheet in USD GPY, and it told me that based on the last 10 years, there was a 65% chance of price hitting my target before taking out my stop. So that's a clear mechanical proven edge. If I keep taking the same trade like that over and over again, it makes me money. So let's go back to the beginning, the concept I spoke about. The concept I spoke about was liquidity. Now look at this area. Equal highs all over. You can bet that people that are short in this area place the stops above here. You can bet that people will be buying. We break it, immediately go down.
Then we break this high, we sit on it, and then look at this move. Huge move. We break this key last low, and then we break this is like the entire low of the range. And we break that as well. We close below it. And this really tells me, okay, someone with more capital absorbed liquidity above you and is now positioned short. And I want to join him. So the red line was my entry and this was my target. And this was my stop. As you can see, the R risk reward is a bit over 1-to-1, but the odds of winning were also way higher than 50-50. This is how I trade: organized, rule-based, based on concepts, built into mechanical trading strategy and then trading. What I want to drive home is look at the difference in price action when we break the high of the range compared to when we break the low of the range. Here we break the high of the range and we just sit on the level, and within a few hours we violently go back. Here we break it, we sit on the level, but within a few hours we move away. There is no absorption here, and that's the difference. And that tells me I have to be short. I take a look at my statistics and my plan, I enter in the order, and that's it. That's mechanical trading. That's the power of mechanical trading. Now, is this something you want as well? Comment down below and I will help you out. If you want to talk to me one-on-one, go to my website, which is in the description down below. You can book a free call. We can discuss your strategy, see how we can make it more mechanical and build you into a profitable trader as well. Thanks for watching, guys. See you next time.